by that from yesterday too, which I'll pop in Dropbox shortly. What I've got there is that the red line is business sector debt to GDP. Now you can see it's grown from about 30% of GDP to about 75, 80% in a cyclical way over time. And that is fundamentally Minsky's hypothesis, that you get a series of booms and busts where the tendency to turn, doing well into a speculative bubble, etc. Then, of course, you have a slump, you try to pay the debt down. But at the same time, it's overlaid over the top of that is, first of all, a gradual growth in household debt, then an explosion. You see household debt began at 25% of GDP, reached about 50% by the mid-80s. Then we've got the whole Reagan deregulation, pumping money into the household sector. And look at the growth of financial sector debt from 2% of GDP to 120%. Okay. Now, so I think...
Just to clarify, this does not include mortgage debt.
That does include mortgage debt. The household debt is including mortgage debt. There's almost no change. This is another important element about individual behaviour. The extent to which non-asset-based borrowing by households has changed is pretty minor. You've had fluctuation in it. They may have doubled, since, say, 5% to 10% of GDP and gone back down again. The one that's exploded is asset-based, because all that growth, pretty much all that growth from 25% of GDP to 100% in the level of household debt is people taking out mortgages. And again, the finance sector growth was partly financing.
Credit card debt, student loans,
not as bad. You've got a special problem now with student loans because the way that they're set up, you can't get out of them. The fact you've got to take them out to go into the workforce. That's a new and I think very, very dangerous development. That in a sense you can see as an asset-based loan because you're supposedly investing in yourself as an asset, and therefore people fall for seeing it. Yeah, fall for seeing. Pardon?
You can sell yourself.
Yeah. So, but that's fundamentally. I divide Minsky's hypothesis in two components. Now I think about its relationship to the levels of debt. One is the investment element of his thinking, which is like taking Schumpeter and then saying on top of the cycle that Schumpeter sees in endogenous money, which is genuinely part of Schumpeter, and levels of investment and so on. You also get the cyclical tendency for it to rise, and you can see that in the red line data. But what you also have is Ponzi finance, and that's where the financial sector itself, and you can see it as an independent entity, realises that the best way it can generate more wealth for itself is to persuade the rest of us to take on debt based on asset speculation, and legitimises that. And this is gigantic growth in financial sector debt. To give you a comparison, I'll bring up a chart which goes back in aggregate private sector debt terms back to an earlier period. With I'm saving this right now, that will take forever on this bloody computer, so I'll come back to it. That gives you an idea that Minsky's hypothesis is there in the data, but more of it relates to the Ponzi behaviour of the finance sector than it does to the investment behaviour of the corporate sector. But they're both there. Okay? So what I've been trying to do in my research is turn that hypothesis into a mathematical model, and I'm going to hit you with a couple of those now, actually three, so pardon me, but here we go. You need... What the F happened then? Oh dear, come back, you bastard. Hang on, just redraw that. Yeah. There we go. Pardon me.
I would like for Mark to just compare what you were doing in your empirical studies with what Steve just showed us. And
well, I haven't done the empirical studies. I'm relying on others who have looked at
okay, but you published reference to them with the graphs, and so I don't completely understand the relationship between what Steve just showed us and what you showed us in the piece. That seemed, I haven't read it carefully enough yet, but it seems to me to be intention. So I would like you to, at the end, when Steve is done, to talk about that tension.
Yeah, sure. I mean, I've talked with Mario, pardon me, about it quite a bit some time ago, and I think, in fact, what was used Canadian data for Paul rightly to talk about a co-integration effect and said that you didn't have the pattern Minsky talked about in the data. And in fact, I argued that I then generated exactly the same pattern in one of my models and showed that if you have that pattern, you got stability. But so he was mistaken regarding co-integration as a way of measuring what's actually happening in the system. That's a long debate. I'll get back to that if you like later. But I don't think what Mario found is actually a reason to say Minsky's hypothesis isn't supported. Because if I then generated the situation that Mario found in the Canadian data that didn't look like it was heading towards crisis, so that look, yeah.
Well, we didn't have a crisis in Canada. Hardly did.
Pardon?
We didn't have.
No, when I was talking with Mario, it was back in '96, so it's quite some time ago. But I think we're looking at that stage of the '90 recession data up to that point. I haven't seen anything subsequent to that, but. I think there's very strong reasons to say Minsky's data, the data supports Minsky's hypothesis in a range of ways. I'll show you why I've gone about trying to model that. And I started from Richard Goodwin's cyclical model of the economy. This is a model that Goodwin developed back in 1967 as a 100th anniversary present to Karl Marx, because it's actually a model you'll find in chapter 25 of volume 1 of Capital. And it's normally put across as being what's called a predator-prey model, which is a model of interacting populations in biology. That just happens to be the characteristic set of models to which this can be mapped in mathematics. But in fact, this predates, because it came from Marx in 67, it predates those models in mathematics by 40 years, and actually 50 years. And in fact, it's a structural model. If you simply look at what you say the structure of the economy is inside of the barest bones, simplest set of assumptions you get the cyclical model that Goodwin put forward in the 60s. So he argued that with the level of capital stock, which is what this K is here, there's a relationship between the level of capital and the level of output, taking the simplest possible relationship and saying there's some constant ratio between output and capital. You divide capital by that ratio and you get the level of output. Once you've got the level of output, if you know how many workers you need to produce each unit of output, divide the output by labour productivity and you get how many workers you need to hire. If you know the number of workers you're hiring and have population, then you divide the employment by the population, you get the rate of employment. Now I'm feeding this into Milton Friedman's fantasy of a non-accelerating inflation rate of unemployment, and saying, according to the argument the neoclassical have, is always equilibrium obsessed. So they say there's some level, if you get unemployment at that point, you'll be in equilibrium. So I'm feeding it and have a bit of fun with this and saying, let's feed in Nehru and say 95% of the population. If there's 5% unemployment, workers neither demand wage rises nor accept wage cuts in the aggregate. If it's above that, they accept a wage cut. If it's below that, they accept a rise. So I then subtract the actual employment rate from 1 minus the Nehru, and that gives me the gap that should be motivating whether workers want a wage rise or not. I multiply that by some reaction function, again just using a constant, the simplest possible relationship to say, let's say, yeah.
Is that the real wage rate?
It's a real wage. Give me 2 models and I'll get to the money wage. Okay. So multiply this by a reaction that workers have to that gap. Like if there's a 1%, unemployment's 1% above the level, then they'll accept, say, a 5% wage cut, that type of relationship. And that's my wage function, which I then, if I multiply it by the current wage and integrate it, I get the wage. It's a piece of straight mathematics differential equation. Then I've got the wage multiplied by labour, I get the wage bill. Subtract the wage bill from output, I've got profit. In this simple model, Goodwin and Marx also assumed all profit was invested. Integrate the investment, you've got capital stock. Now, the usual thing is, if I can get students to build this in about 20 minutes if I talk them through it, neoclassicals think everything reaches equilibrium. What you get when you simulate this model is permanent cycles in both employment and wages share. And to do Minsky's vision justice, you have to have a cyclical system. So that's the starting point of the model. Okay. So let's just let that one do one little cycle and then I'll shut it down and go to the next one. So that's what I started from with Minsky's model. Employment and wages share of output. So it's the software slowly being developed. Actually, only just in the last, 2 weeks, Russell has added the capacity to put a label in here. So if I put wage share versus employment, then that's a bit more obvious as to what it'll be. Bloody awful formatting, I'm sorry, in terms of scale. Hit the wrong key. It'll turn up in a moment. Okay, so that's the basic model that gives you cycles in Minsky. What I added, first of all, in my modeling of Minsky was let's make this one a bit smaller, was to say that capitalists don't simply invest all their profits. They invest more than their profits during a boom and less than their profits during a slump. Okay, and therefore the rate of change of debt is actually investment minus profits. And then profits themselves are now net of interest payments, so you feed all that in. And that in the initial thing gave me a model of a cyclical system which could have a breakdown, but it was non-monetary. So one reason I developed, non-monetary, the question made about the real wage earlier. So one thing that I've been trying to do for 20 years since I first developed Minsky model is to build a monetary system, because to have a price level, and it's essential, in my opinion, to work in nominal prices and actual money rather than the neoclassical fantasy of a real economy and so on. That's why I built this financial approach that I can now build a monetary model in. So what's sitting actually back here, and I'll just see if I can bring that one up on screen, is a double entry bookkeeping financial system, so that when capitalists invest, they borrow money to do it. When they pay wages, they're paying wages in money, etc., etc. And that's all. But when I first did this back in 2010, I didn't know the importance of double entry bookkeeping. I now do. So I've extended Minsky to include that. So this is all double entry consistent modelling of it. This is, again, a pure accredited economy. I'll come to a government one in a moment. So with this system, I've now, as well as, I'm not going to try to go through all these bits and pieces on a screen as small as the one we're looking at here, but what's actually going on over here is a debt cycle, so the debt's being generated in the system, and prices are also part of the dynamic. And one interesting thing is I found there's almost no difference between neoclassical pricing theory and post-Keynesian once you put it in a dynamic guise. It's just the fact that neoclassical is obsessed by equilibrium and this madness of believing in marginal cost and marginal revenue is the basis of equilibrium, that you get a divergence in the two theories. Anyway, pardon? Maybe. Well, I'm talking largely Koleski's markup pricing model. Okay, but let's leave that for later. That is a different topic. So when I simulate this model, oh great, I get a crash in the program. Fantastic.
How fitting. Stability is
I'll see if I can bring up. Let's see if I've actually still got it as a recent file here. Pardon me, I'll have to go back and see if I can load that. It doesn't normally happen. This one is actually functioning pretty well right now. Just give me a couple of seconds, please, and I'll just see if I can find the file. Having extra ones open may have given it a hard time. Let's see. Okay, that's the one I want. Let's go and see if I can run it properly now. Okay, what you've got happening, I'll just change the scale. Oh, great, pardon me. I've just, by pressing that key, then I actually whacked an extra object on the screen. I just, one of the things about this pen, you can actually unintentionally add elements to the system without realizing you've done it. Put the touch. Let's bring it in here. Again, the scale of the screen is a pain. Just so let's make this a bit larger. The key thing in Minsky, and I'll just let that particular graph show up, is the ratio of private debt to GDP. That's what Minsky fundamentally adds to both the good vision I've seen you, and of course the neoclassical idea of what's going. Pardon me. That's just notice I brought a sine function down without meaning to do it. Okay, let's just see if I can now run it properly. Yeah, okay. This is the debt to GDP ratio. Now, what you'll notice, private debt to GDP, you'll notice it cycles away. And what is actually happening is cycles, just we see in the real data, rise and then fall. This is just a corporate model at the moment. If I had private sector, if I had Ponzi debt into it, then it becomes a super cycle version of this. So this is like just as corporate sector is borrowing, but with that alone, you get this tendency towards a debt deflation because you get rising level of debt to GDP. Looks like it's settling down. You can see that seems to be stabilizing. And this is one of the intriguing things about putting this into a model. It doesn't just give you the crisis, it also gives you what appears to be the great moderation. Because if you're looking at the level of employment, I'll see if I can change the scaler without bringing another bloody object on screen here. Okay, look at them. Pardon?
This is the coefficient including or excluding?
Excluding. But I mean, again, this is all to be generalized at some point. It's just as if you only got any borrowing being done here is to build a factory. So it's fundamentally industrial. But notice the employment rate is stabilizing. There's the employment rate down. If you saw that, you're looking at that, and also look at the inflation rate, which is also stabilizing. So you look at those two and you think, wow, I'm fantastic. I'm a brilliant Federal Reserve chairman. Let's quell this great moderation and thank me and my neoclassical colleagues for bringing about stability. And then all hell breaks loose at some point. And this is because what's actually happening in the background that they're ignoring, and you can read explicitly why they ignore it in their own literature, a rising ratio of private debt to GDP. It's still rising, as you can see, not fluctuating as much. You reach what's actually happening, and this, if I can highlight this chart here, you can see the wages share of output is declining. And it's actually a prediction of the model that if this falls, this rises. Capitalists who are seeing a completely stable rate of profit continue investing. This decline in wage share allows this offsetting increase in the debt ratio without affecting capitalist propensity to invest. But then at a certain point, the exponential element in this takes over. This starts to really collapse at the same, but not fast enough to compensate for the rising debt level. And watch what happens to employment. It's slowly going down the gurgler. And all of a sudden, you've got deflation over here and collapsing employment, which is what we had with the great transition from the so-called great moderation to where we are now. So I think we can capture a large part of what Minsky's hypothesis is.
Yeah, we can almost capture by building a model that will mimic.
I built this in 92.
Well,
okay.
I saw your article in 95, and it was a supply-led model.
Yeah, but this is because I simply hadn't had a chance to make it a demand-led model, which this now is. I had to build a financial system, etc., etc. But the same basic concepts mapped through. And this is what one reason I wanted to talk about the work being done by Matthias Griselli and co. is that they're...
Wait, there's a question before you go to the next.
Yeah.
The Marxian model, that Goodwin model, it is over time. It's not just a cycle, because the structure of the so long, Mark.
Yeah.
We won't ever finish it.
Take care.
Yeah.
See you next time.
The structure of the economy is changing because there's an increased capitalization and mechanization when they throw workers out of work and increase the capital intensity of production, right?
You're talking organic composition of capital here.
Well, that's how Marx is. That's what underlies the changing capital intensity.
No, I'm actually talking about a specific model in section 1 of chapter 25 of Capital. I'm not talking about the whole labor theory of value or...
No,
yeah.
Either am I.
Yeah, okay. But that particular model...
Of
that
capital, there is a cyclical model.
Yeah.
What I'm saying is, when the wage rises and people are thrown out of work, the capitalist is changing the capital intensity of production to a more capital intensive method, right? And when they hire again, they don't go back to the old lower capital intensity. They employ re-employ the labor from the reserve army at the
that's all in the model
right.
I've just shown you.
Okay, great. So what's happening is basically a kind of technological unemployment in a way, right? And so what I'm asking is, in this third model, the third, when you have the monetary and financial version, then are the cycles due to purely monetary and financial factors, or?
Oh, they're both. They're both monetary and financial and physical. There are numerous sources of cycles in a capitalist economy. So this is that particular one, and the Goodwin model starts with a purely physical income distribution, dynamic driven cycle. So you've got to have a changing attitude. Workers have to react to the unemployment rate. all capitalists have to react by paying higher wages. That's an essential part. So it's an income distribution cycle, and driven by, and I've done it, that particular model I showed you. I simply had a constant population and constant labour technology, just because it's the simplest one to build very rapidly and explain.
Driven by.
Well, yep, it's driven. There's
one is constant technology.
no, the third one is changing technology and changing population. The same characteristics manifest in whether you're talking in constant population and constant technology or rising population, rising technology, because the driving factor is actually competition over the distribution of income. That's the basis of that cycle.
Primary driver.
That's the primary driver. Wage, profit, competition. And then what is left out of Goodwin, and this is explicit, Richard Goodwin and I corresponded back when I wrote this model, and he tried to persuade me not to include monetary factors, because he was very much against including monetary thinking because of his own experience in doing his own PhD, which I think was a mistake. Not his PhD, but his conclusion that money didn't matter, based on his research between the First and Second World War. So my idea was always to use Goodwin's foundation, which I thought was fantastic, and put Minsky's ideas on top of it. And the ironic thing is they worked at the same university and clearly did not get on, because the way Goodwin wrote to me about it, he said that Minsky swanned in some particular date in the 60s into wherever Goodwin was, and clearly they never really communicated, and it may have been that divide over monetary real that was part of the reason why, but I tried to bring them together. Yeah.
What determines output?
Pardon?
What determines output?
Level of capital, level of investment.
So
and
it's not aggregate demand.
Yes, as well. The aggregate demand is this.
Is it one or the other?
It was the first model. It was level of capital, and this one is level of capital and aggregate demand. The aggregate demand will change the amount of capital you're employing. So it's all.
So what you're saying is aggregate demand will increase the level of capital, and the level of capital will determine the level of output.
Yeah.
So if you have 100 machines, you know it's going to produce 300 widgets, and that's what's going to be sold.
Yeah, but you will also have, there's markets don't clear. So you'll have
So you have inventory.
You have inventory. Then necessarily you've got differential equations, you've got inventory. But there's a level of, at any point in time, there's a certain amount of output in existence that has been sold or is not yet being sold. Okay, and you'll vary the amount that's being sold, and that will therefore feed back through the system. So there's inventory, there's aggregate demand, etc., etc. So.
Is there feedback? I'm sorry, it's such a naive question. Is there feedback between the price level of output and the decision to invest in this model? Where does that?
Yeah, again, because the price level will determine the rate of profit. Have a feed into the rate of profit. It will also feed into the cost of capital, etc., etc. And again, one thing I haven't yet done is have two price levels. But Minsky also talks quite convincingly about two price levels, and I found that in empirical data as well. So you need to have a price for capital, which varies more radically than the price for consumer goods, and that therefore in terms changes the rate of profit, etc., etc. So there are many ways you've got to generalise what I've done, but that's the start of it.
A quick concrete hypothetical, just to make sure I've got the model clear in my head.
Yeah.
So you've got a political struggle over the distribution of the surplus between profits and wages.
Yeah.
Profits win. Reagan becomes president. Unions are busted. Profits win. What happens? I mean, in other words, if the struggle for some sizable length, some length of time, 10 years, 20 years, tends to go all together to the
well, actually,
profiters.
what tends to happen is the winners end up being financial capital, not industrial capital.
That's interesting. And why is that?
Because when you take the model and produce a reduced form that looks at what we call the system states, the intriguing thing in the Goodwin model, it's two-dimensional, and the two system states are the employment rate and the wages share of output. And it has one equilibrium, or two equilibrium, one of which is called the trivial equilibrium, zero employment, zero wages. You never get there unless you start there, so it's trivial. The other is positive wages share, positive employment. That's an equilibrium. When you go to the model with debt, it becomes a three-dimensional system, the third dimension being added is the ratio of debt to income, debt to GDP ratio. And there are three system states, which are wages, share of output, employment rate, debt ratio. When you look for the equilibrium is the employment rate, the debt ratio, and the profit share, not the wages share, the profit share of income. And then you look what the wages share is, and it's directly inversely related to the debt share and the rate of interest. So even though this is all the emergent nature of the model, what you find is that to have rising debt share, you will necessarily have a falling wages share. So the class conflict, in effect, that actually manifests itself is not between workers and industrial capital, it's between workers and financial capital.
And debt is homogeneous in the model?
Pardon?
Debt is homogeneous?
Yeah, debt's homogeneous. Again, it's easy to...
It doesn't matter if it's like one day at a time in the wholesale market, it doesn't matter what the structure of the banking system is, none of that stuff.
No, they're still two very simple. I mean, the whole idea of this is to start with a simple structure and then make it more elaborate.
It's hard enough to get this
Yeah.
going. You can't introduce these.
Well, you can one day. I hope somebody does, but you've got to start from a certain point. Again, like Mark and I, starting with private sector modelling, because that's the point to start. And then you add in the government later, and then you add in lending for Ponzi finance and so on.
What's happening to the industrialists in the struggle between?
Nothing until the system collapses.
What do you mean nothing? You mean
Well, they're getting cycles in profit around the equilibrium because
so they're not doing better or worse.
They're doing fine until it all collapses and their profit goes to zero.
So in your model, the workers are, in a sense, paying for interest on debt, in the sense that their real wage is getting reduced by the interest payments on debt, whereas the capitalists, the entrepreneurs, get the full amount of profit.
Yeah.
They just raise prices to compensate for the increase in interest payments.
Effectively, yeah. And then ultimately the suffering comes at the end when the whole system breaks down when debt becomes explosive.
Sort of a political economy story between the rentier and everybody else.
Yeah. Now, just to bring in the modern monetary theory part, Minsky also argued that government spending could stabilise an unstable economy. So this is something I did back in the 92 model published in 95, and I haven't yet had a chance to build a government sector into my monetary model. But when I ran the system with government, you now had a fourth dimension, the fourth dimension being government spending. And what I simply had was that government spending would rise if unemployment went above a threshold level, and would decline if it fell below that threshold level. And what it gave me is that the fourth dimension is now the government debt to GDP ratio. And that led to this remarkable behaviour you'll see in a moment. Again, I want to make this monetary, so part of what I'm trying to build is to build in the monetary ideas you guys have got, and then have government spending actually being monetary and feeding in through dole payments and that sort of thing, and then affecting the profit that capitalists are making and so on. But the system now became, it looks like, I could call it complex dynamics. I know, in fact, that it's not because of the mathematical nature of what's going to happen here. But you get cycles that don't lead to breakdown. And that was Minsky's, another one of many fundamental points, is that in a capitalist economy, you're not trying necessarily to prevent cycles. What you're trying to prevent is a Great Depression total breakdown. And so this is a model where the initial conditions I've set it up for would lead to a total breakdown, like the debt explosion I showed you in the previous model, if it wasn't for government spending. What government spending does is it constrains the system so you don't have that explosive growth in private debt. It stabilises, but it still cycles. So the system continues to cycle, but doesn't break down.
The interest rate is constant.
Yeah, I haven't actually made the interest rate variable. Again, that can be done. Like what you then have, and this is a elaboration, when we're talking about the interest rate, when I'm saying here we're talking the cash rate. Of course, the rates that commercial firm banks charge as a loans rate, which will exceed their deposit rate, which will exceed the cash rate. So with government policy, you could have the cash rate would be varied. The gap between the loan rate and deposit rate doesn't change all that much. But you'd then be saying, what's the impact of dropping the cash rate as a policy move to bring a change into the system? Again, those are the sort of elaborations I'd like people to do over time in the system from what I've built to begin with. But
this has a kind of unique bank.
Pardon?
This model has a kind of unique bank folded into. So when industrialists need to pay the wage bill,
yeah,
it's as if they're borrowing from a unique bank where there's a notion that their expectations about the level of profit will be validated.
Yeah. I mean, fundamentally, you start off with the proposition that the banks will lend what the firm sector demands. So, again, large part of the endogenous money vision. Not that the banks are passive, but that they'll do that. But I've also, in that model, I've got banks varying their willingness to lend, depending upon economic conditions as well. So,
but there's no uncertainty, right?
Pardon?
Here, so
Did you say no uncertainty?
No, credit provision expectation does not seem to be mitigated, right? So you don't say the bank that is lending seems to have in this model full knowledge as to
no bloody way. No, no. Let's get rid of this whole notion of full knowledge and all these neoclassical ideas of how you can talk about the future. The bank knows its own situation. It knows what the rate of profit is and the people it's lending to, and it will then, as Keynes argued, with an uncertain future, what people do is to extrapolate current conditions forward. So what I've got in terms of behavioural relationship, which are inside this box here for the wage function, that one for the government spending, and this one for investment down here, is that firms' desire to invest depends upon the current rate of profit. They extrapolate forward current conditions. Workers' demands for wage rises depend upon the current rate of employment. They extrapolate forward current conditions. When you do that, you get a complex system that nobody can predict. Okay, and that's a large part of Keynes's vision about uncertainty as well.
And everybody knows they can predict it.
Yeah. But the thing is, you therefore have to make a decision. You know, that's one of the 37 papers.
Yeah.
A beautiful statement.
37.
Yeah, saying that because of the uncertainty of the future, current conditions influence decisions in an excessive way, and yet there's nothing else you can do because no other basis exists to make a calculation.
I'm not sure exactly how that insight is expressed in model terms. In the sense that's my
In this particular thing, it's simply saying that each entity or social group in the system reacts to the knowledge that matters to them about the social system, but they don't understand the entire social system. Whereas the neoclassical vision is everybody reacts to everything they know about the entire system, and they all know the entire system. So there's what I call the neoclassical vision of rationality is meta-rationality, where everybody in a system completely understands how it works, knows what will happen if anything changes in the future, and therefore can predict the future.
There is a kind of determinacy of the level of individual.
Pardon, sir?
There is a kind of determinacy of the level of individual agents. Individual agents follow a path that is in some sense certain, even though it's not in tune with the system. Right? It's not uncertainty in the sense that I would say, I'm a banker, I don't know if I'll lend to you tomorrow. I know if I'll lend to you tomorrow or not. What I don't know is what the outcomes of that.
Yeah.
You can't model what's in Minsky and what is in Keynes, lenders risk, borrowers risk.
Oh, sorry.
Your model doesn't have, in the sense that Minsky used it, lenders risk and borrowers risk. And the convergence between the two, different perceptions about the likelihood.
Not strictly, but it's the other model I've got, where I've got the price system does have bankers reacting to the rate of profit and their willingness to lend. So their willingness to put money out declines when the rate of profit falls. So I've actually built that in. And again, it'd be possible to make it more elaborate than that, so to have them reacting to the debt to GDP ratios or debt to asset ratios. All that's feasible. It's the whole idea of building this particular software package was to build a platform on which we can explore these ideas, rather than building a specific model. But this is expressing my model on that platform.
So what's this wormhole?
That's what I wanted to show you. This is the ratio of employment and on one axis, employment rate, and wages share of output on the other. And this is rather than getting the model I showed you before, you had a collapse in both. Employment collapsed and wages share collapsed. And in this model, which is the government sector spending countering what the private sector is doing, you continue getting cycles. You plot the two together, you never get a breakdown. And the cycles never repeat themselves. They're aperiodic, deterministic cycles, which is the sort of thing neoclassicals have a very hard time getting their heads around. But it's a commonplace in proper mathematical modelling these days to get a result like that.
So the whole issue here is to build a model that expresses mathematically
Yeah.
and then compare the results predicted by the model with our current experience.
Yeah, that's the ambition. I mean, I'd never wanted to do that just with the real sector model because, as Mark points out, it didn't properly have aggregate demand inside there. It didn't have the financial sector, etc., etc. And I didn't want to attempt to model a system like that against the real data. But let's say with this one, I'd be more willing to give it a try. And if you take a look at the qualitative behaviour of the economy, that combination of a exploding level of debt and then apparently stabilizing employment and stabilizing inflation, followed by a collapse. Qualitatively speaking, that's exactly what we had, a period of declining cycles in inflation and employment, which the neoclassicals thought was fabulous outcome for them, and a rising level of debt to GDP, which they ignore because it's not part of their logic. And you put the two together, we finally had a collapse. And this model generates both those, not just the crisis, but also the great moderation beforehand.
This sort of 30-year period.
Yeah, this is starting. This has got an arbitrary starting point of debt to GDP ratio of 0. This particular simulation I'm showing you. Of course, we started at 45% in the Second World War period. So there's arbitrary starting points and largely invented but realistic parameter values. So to make it work better, I'd need to then fit it to the actual initial conditions and to empirically estimated data. But that gets you caught up in some quite complex mathematical parameter fitting, well beyond the usual linear regression that neoclassical economists use.
And then, do I understand correctly that as Minsky would say, the tipping point just comes because once you reach some threshold level of private debt to GDP, almost anything can trigger.
Yeah, and this is the beauty. I'm showing you debt ratio here. But what's actually happening if you look at the nominal level? The nominal level is actually falling, but GDP is falling faster, and that's exactly what happened in the Great Depression. The debt level in the Great Depression, when the crisis began, was 175% of GDP, and
level of who?
Private debt, all corporate, household, and
So
financial
that's
sector.
precisely the point. The point is that before the Great Depression, the debt level or the debt ratio of the corporate sector wasn't any higher than it was 7 or 8 years before. What was much higher was the household debt.
No, in fact, if I can bring up the data on that front, I think I've got it over here.
Heisenberg, who was looking for Minsky evidence, published her paper 1 year ago, where this is what she showed.
It was what?
It was household debt that was rising just before the Great Depression.
Give me a moment to extend the data. And take it back a bit. It's in fact, I've got a very arbitrary naming system here, I'm afraid, so I've got to go searching to find what I call the long term. But in fact, that isn't the case. Let's see. Okay, got these terms here. The ratios, I can remember them, but I can't pull the data to take a bit longer. The ratio of corporate debt to GDP in 1930 was 125% versus 70% this time at a much lower level. And financial sector debt and household debt to debt was 25% each, roughly, when the crisis began. So aggregate level 175, 125 corporate, 25 private, 25 household, 25 financial sector. This is data from the US Census. So, I mean, I'll stick with the US Census data. I'll show you, I can give you the URL to find the data, but that was the aggregate position. So it wasn't an explosion in household debt. It was actually corporate sector debt that had got to be to a trigger level. I mean, lots of issues as to why it happened when it did, but it was corporate sector debt that was the major contributor back in the 1920s, whereas this time around it was household. We do have a different characteristic between now and the Great Depression in that sense.
We had some localized real estate.
Yeah. I'll just actually see if you just give me, let's see.
Heisenberg is real nice. For numbers.
Yeah.
There was shenanigans in the corporate sector, including the family.
Yeah. Again, I wasn't prepared to answer that, but I'll show you later if you like. I'll bring up a chart later on in the session and show you the difference. So I've forgotten why we're raising the point of that. Yeah.
So would the dynamic be the wormhole? I mean, if employer of last resort, do you get around the wormhole problem because they're controlling the wage, the remuneration, can you measure the wage?
Creation going from the first model to the next one, some type of employer relationship dynamic, because you've modeled government spending as responsive to unemployment.
Yeah, but when you've got a complex system, you certainly can't instantly target and say you're going to make one particular thing completely constant. Okay. What I haven't got is government employment in this model. I've got government spending into the private sector that was a subsidy, really.
A quick response.
Yeah, sure.
Question. You can think about it this way: that in reality and in Steve's model, the expansion and contraction of output and employment, right? When the economy contracts, unemployment goes up, right? With the ELR program, when the economy contracts, the job guarantee program expands, and then when the economy goes into an expansion, in Steve's model, in reality, unemployment goes down, but in job guarantee program, the job guarantee program would shrink with, the ability to modify that, fine-tune it with other fiscal and monetary policies like spending, taxing, and interest rates, like that.
I'll add to that. With ELR, you don't completely eliminate business cycles.
Yeah.
You'll have that buffer stock expanding and shrinking with the business cycle, but you're minimizing the impact of the business cycle. Because once you guarantee employment, you stabilize income, which stabilizes consumer expectations, business expectations. So you're also indirectly stabilizing investment because the business sector is expecting stable employment conditions, stable demand conditions from the consumer sector. So you're taming the business cycle, but you never completely.
Yeah.
You're modulating it, right? You're lowering the amplitude of the swings.
And guaranteeing a source of income, source of employment, fulfillment, all of that.
One important, underlying implication of that is that the job guarantee approach to full employment, unlike the conventional Keynesian approach that just tries to stimulate demand generically through just government spending or tax cuts, recognizes the functionality of unemployment. Keynes saw that unemployment was normal in capitalism, but he thought it was totally irrational, and therefore he underestimated the challenges to crafting an effective policy because he didn't recognize what Marx did and Gillespie, the functionality of unemployment. The unemployment serves a purpose. It is, in a sense, rational or functional within the logic of capitalism, holding down wages, keeping prices down, and providing a pool of labor, disciplining workers.
Taming wage demands.
Right. So the job guarantee program, factors recognition of the functionality into policy. It's an important difference between a conventional approach.
Wouldn't you say that unemployment and productive resources and employment of real capital is the same function? It's a discipline of capital, right? It's a buffer stock against the ability of capitalists to charge higher rents once capital becomes scarce, once physical capital becomes scarce. There could be a symmetry between the unemployment of labor and the unemployment of productive capital.
That does seem to be part of the Keynesian vision, right? He seems to have spoken in exactly those terms, right? Basically, you diminish the power of the rentier, right? That finds expression in high interest rates.
I think the main advantage of ELR is that it is spatially focused to the regions where there is a high rate of unemployment, whereas if you decrease the overall tax rate at the federal level, it just has an overall impact. And I remember a presentation by Galbraith maybe 10 years ago where he showed visually the different rates of unemployment in the various counties across the states in the United States around 2001. And so during a time where unemployment was high. But in some areas of the United States, the rate of unemployment was very low. They were at full employment in those areas. And so that to me was quite a good a good way to see the true purpose of PLI.
And it's very regional. We're talking within a 10-mile radius. There's a huge difference. A lot in the Midwest.
It makes good use of the lower degree of mobility of labor too, right? I mean, one of the theories behind the Federal Reserve System's regionalization originally was that you would have a certain degree of monetary policy autonomy from region to region. That's pretty difficult to maintain now, of course, because arbitrage is so much easier when it comes to capital movements. Labor movements, on the other hand, remain stickier. So you can actually have it's a much more realistic proposition to sort of vary policy region by region if you're working with a buffer of labor rather than with a buffer of capital. Is that somebody's thumb drive, by the way?
Yeah.
Oh.
Yeah, pardon me. Making a mess of my screen here. I'll have to do it later. I'm trying to do it while we're talking. I'm not going to get there, so I'll just shut that down.
But I did say, in Minsky, you go into debt for a wide variety of reasons. One is investment. Much more important since 1980 has been to buy assets and do leverage buyouts. I think it's completely implausible to argue that leverage buyouts did not lead to much higher debt ratios relative to cash flows.
Sure.
That was the purpose.
That was the point of it.
Exactly.
Okay?
Yeah.
And that is what he's arguing. So I think looking at the aggregate investment ratio, the aggregate amount of profit, which by identity holding everything else equal, the profit must go up with investment, is not challenging important. Because the problem is that given that there are a whole bunch of reasons other than investment, and those other things do not create profit. If I go heavily into debt to buy a cash cow that isn't indebted, put them into debt, there's been no profit created whatsoever. Although I have put that on them. I make good fees for doing this, but there has been no profit. It's what Minsky